How's it going, guys? Today's topic, I want to discuss pension annuity versus lump sum and really break down if you're offered a pension plan and you may be getting either a income stream option through that pension, or you might be having some sort of buyout option where the employer, the company, is going to be giving you a lump sum option where you could take a large portion of dollars and basically walk away and forego your pension, forego the income stream, or kind of a caveat to the lump sum option is the company may say, hey, we have an insurance company also built within this plan that they'll give you a type of annuity within that type of lump sum buyout. So I want to go over all the pros, the cons, and really to take a step back. What's the whole purpose of this is to try to get you to your ideal retirement that you envisioned as quickly as possible, removing financial stress, removing deathbed regrets. If you're able to easily get from now until your ideal retirement date without financial stress, and then from your ideal retirement date until date of death, that's obviously a win-win all across the board. So based on the different personalities, the different kind of mindset off of what an individual likes at from a risky standpoint versus safety standpoint, that's obviously going to position you one way or the other. Really, at the end of the day, is I just want to provide as much value to you guys as possible. If you are interested in speaking further about this, you could give our 1-800 number a call. It's 1-800-566-1002, or schedule an appointment through our calendar link that's going to be embedded in the description of this video. So first, I want to speak about leveraging a pension income stream or a pension annuity aspect that maybe the employer's giving you that option with the lump sum, where you could actually use an insurance company and use that annuity option within the pension lump sum buyout. So it's kind of it's very similar, these two techniques, but just be mindful that what the company's doing when they create a pension plan is known as a defined benefit plan. You're working for a company for X amount of years. So if you work there for 15 years, 20, 25, 30 years, there's going to be a specific portion of your salary that was being sent over into this type of defined benefit plan where the employer's saying, okay, this employee has been very loyal to us. So what we're going to do is take care of their retirement and give them ultimately a retirement paycheck when they're no longer working. So you don't have to worry about having to go back to work, because the combination of your pension income stream could be lifetime income, Social Security could be lifetime income or is lifetime income, and then any other assets that you've saved, you could use as supplemental income or emergency needs or growth needs or vacation expenses, whatever that case is. So it's a very important, part of your retirement, and could be something known as the three-legged stool, where when you're receiving income in retirement and you don't have to work, that's obviously a very good thing. If you don't have income in retirement, then you don't have a retirement. So how can we maximize out that income stream or figure out what's the best way possible? And first, you see single versus joint life. And the story that I always talk about on all my videos whenever I discuss pension is my grandfather was an elevator mechanic for the city of New York. And he worked for the city of New York for X amount of years of service. Right when he was in his late 50s, right when he was nearing his retirement date, he basically filled out the form, because when he got his options, it said, okay, your pension income stream, you're going to get X amount of dollars if you want to trigger single life, or you're going to have a lower amount if you want to trigger joint life. Well, he looked at the shiny object and said, oh, look at this. This is thousands of more dollars in my pocket if I trigger the single life. I'm going to live a very long life. Well, when he signed the paperwork and he was walking out the door, my grandmother stopped him and said, hey, what's in your hand? They discussed it. She flipped out on him, and she ultimately won the argument. He changed it to joint life. Now, why do these pension companies, or why do these employers that have the defined benefit plans, why do they give you more for single life than joint life? Well, simplistically speaking, they're either covering one life or they're covering two lives. So there's a larger risk if they're covering two lives. In my grandfather's example, he ended up passing away at age 69. My grandmother was about a year apart from him. She ended up living well into her 80s. So if they would have chosen the single life option, they would have received a much higher income stream from when he retired in his late 50s all the way to age 69, but then that income would have stopped. Luckily, when she stopped him and won that argument, that income stream kept coming to her. So there were thousands and thousands of more dollars that was getting paid to her. She never had to struggle. She was able to basically live every single day throughout retirement, knowing that she had her Social Security income was coming to her, knowing that she had her assets that they basically saved together, and then that pension income stream, because of obviously the choice that she made. She lived a much longer life than what my grandfather did. So that was obviously a win-win. Now, really the purpose of leveraging a pension plan is you want to make sure that your monthly income is greater than or equal to your expenses. So if, case in point, let's say if somebody's receiving, $60,000 from their pension income stream, another $40,000 from their Social Security income, that's $100,000 of income that's coming to an individual. If their expenses are, let's say, $60,000, that's a win-win-win all across the board. They don't not necessarily have to dip into other savings to pay for those expenses, especially, necessary expenses. So maybe they might have another splurge account or additional retirement savings to use as their fund monies, their vacation funds, or an inheritance maximization to say, when I pass away, this is what's going to get left over to the beneficiaries. The downside to pension income stream is that you're basically receiving lifetime income, but whenever you pass away, or if you chose joint, the second spouse passes away, that income's ultimately going to stop. So if you guys both pass away prematurely, there's no money that's getting left over to the beneficiaries based on the income option that you choose. And typically an individual chooses either single life or joint life. So that's why I'm making that statement. So this is where with pension organizations or really employers have started coming out and saying, okay, we'll give you a lump sum option that will be different than just receiving the income stream. If we pay it to you in the form of a lump sum, you get to decide how to invest the monies. You get to decide how to take out the income from this, but it's not lifetime income streams. It's basically, here's a bucket of money. Figure out it's going to be qualified accounts, meaning that if you're trying to invest it and trying to grow it higher, and then you start taking distributions, you're going to be fully taxed on those dollars because it's a qualified, type retirement account status. Now, when individuals have been trying to do that on their own, if they hit some bad market downturns and they're trying to pull out monies from those accounts, that's obviously a large negative. So now you had these pension companies basically, or these employers started coming out with an annuity option within that lump sum option. So what it says is, rather than you control all the chips, what we'll do is we'll pay you an annuity, or you could go with company XYZ annuity. So they'll pay you lifetime income for you, lifetime income for your spouse. If you guys both pass away prematurely, there's still an account balance that's sitting there, which sounds good because it's kind of allowing you to have your cake and eat it too. But the negative to it is you have hundreds and hundreds of different annuity offers. If you were just to take the lump sum and then figure it out on your own and get with an individual type annuity IRA, that could give you much higher lifetime income on a single life, much higher lifetime income on a joint life, much higher growth potential than typically what that one pigeonhole annuity is giving you with that offer. So that's where I want to expose it and say, okay, does it make mathematical sense to either go purely with the income play on the pension plan, or do you want to take a lump sum? And would you want to take the lump sum with the annuity option, or just take a lump sum and basically customize that on your own? And typically it makes sense if you're going to use the lump sum to customize on your own, as opposed to going with that one annuity carrier, that's offered through that pension plan. So there's some different, obviously pros and cons. Regarding the pension plan, just understand if you're receiving income, it's a retirement paycheck when you're no longer working for that employer. They took care of you because you took care of them. You're a loyal employee, so therefore they're going to benefit you. So instead of taking your pension, your income option, and basically a single life, joint life, period certain, the different income related options, an employer may come to you and say, hey, listen, I know that you're really close to that retirement stage. What we're going to do is give you a lump sum buyout option. So it's going to be hundreds of thousands of dollars that you could go and forego the income stream and therefore take this lump sum, keep it in a qualified retirement account status, and figure out exactly whatever you want to do on your own. Why do the companies do that? And you got to think of it from a risk standpoint. If individuals are living longer and longer every year, and spouses and married couples, and the statistics are showing with technological advances that individuals live longer throughout the length of time with all these different, obviously health advances, that's a larger risk. If, let's say, they expected when they first, offered the pension plan, they expected individuals to pass away at age 75 or 80, but now individuals are living past the age of 90, now they have to account for 10 extra years of thousands of more dollars coming off of their books going, getting paid off as benefits. So this is why a lot of companies started giving these buyout related options. Now, does it make sense to take the buyout option? And it really just depends. It depends on really what your specific situation is, what your cash flow situation is already in retirement, and then what's the difference between what they're giving you for income from the actual pension play, Or is that lump sum a large enough figure where you could take the dollars, reinvest it on your own, customize it on your own, so you're able to kind of have your cake and eat it too? Can I at least spit off a specific amount of dollars from this lump sum to create an income strategy so that my income streams are covered? I'll also have money left over from that lump sum that I didn't use up so that I could use for emergency needs and then ultimately for my growth needs. So like as an example, let's say if somebody has $80,000 of expenses and they have $40,000 coming to them of Social Security income, and then so they need another $40,000 from their actual pension. Well, maybe the pension's giving them 60 grand. Lifetime income stream. That sounds great. $60,000 every single year. That's $60,000 plus the $40,000 of the Social Security income. That's going to be much greater than or equal to what the person's expenses are. But they take a step back and they say, oh, wait a second, this company's now giving me a $700,000 or $800,000 lump sum buyout option to forego that $60,000 of income. So use the example of $800,000. Does it make more sense to just trigger the $60,000 from the pension income stream, forego the lump sum option, or take the lump sum option, create your own strategy, and then basically get you to whatever your necessary expense need or your necessary income need is for that example? And this is just a generic example. So with that 800,000 example, maybe it's only going to require $400,000 from that 800,000 to place it into a customized IRA that's going to spit off that $40,000 of income. So you have the $40,000 of income from your Social Security, the $40,000 of income that's going to be coming from your IRA account. So the combination of that 80,000 is going to take care of that individual's expenses. And now what do they have left over? Now they have a new bucket of 400 grand left over to take care of any emergency needs, any inflation growth related needs. They could do vacation funds, inheritance maximization. They could leave a sliver of dollars for just fixed related growth, for aggressive related growth. Really, the sky's the limit with that example. But once again, it depends on how much that individual needs from an income standpoint, and is the lump sum large enough where you could actually go and kind of finagle the numbers to your benefit, or would you be shooting yourself in the foot? Case in point, let's say one company's giving you $60,000 of income, and all of a sudden they're coming to the table with a lump sum option of 300 grand. Well, $60,000 of income is a large amount, especially when you're comparing it to a lump sum option of $300,000. The shiny object is showing you $300,000, so individuals might lead towards that way. Oh, I could take the $300,000, I could invest it better and get all this. But the other is $60,000 of pure cash flow that's coming to you. So in that scenario, it would make more sense to leverage the lifetime income stream that pension's able to give you, as opposed to doing the buyout. Obviously, there's different math and there's different questions involved to really figure out with your specific situation. But just be mindful that when leveraging a lump sum pension, you could optimize, you could basically customize it into IRA and then splice it off into multiple IRAs so it's optimizing each specific goal. You could optimize one lane for an income need, one lane for an emergency, meaning like liquid cash if you need to in case of an emergency, in case of an oh my gosh moment was to occur. And then you kind of a tertiary need for just pure growth play. And that growth could be spliced up into a whole slew of different things. So in the example of, let's say, you're getting 600,000 of a lump sum and it requires 200,000 to take care of your income gap, then you have another, let's say $50,000 to leverage for your emergency related needs in case of an oh my gosh moment was to occur. And now you have, an additional 350,000 that now you could play with. Maybe 50,000 is going to be set aside for very aggressive ETF blends or no load mutual fund blends or whatever that is. It's going to ebb and flow with the market. Another 100,000 is going to be into some sort of high fixed related account. Another 100,000 is going to be kind of more of a moderate blend. And now you have basically 4 to 5 different IRA accounts that are working in tandem. That's giving you all these benefits of income, emergency, growth. If that individual passes away, that income related bucket will still leave monies over to beneficiaries if there's still an account balance there. The emergency need will still get left over to beneficiaries. And then those tertiary buckets of the growth and inflation protection, that'll get left over to beneficiaries. So it's kind of a win-win-win all across the board, but it depends on what you're foregoing with that income stream. If the income stream is really high versus what the lump sum option is, then do not take the lump sum option. You're shooting yourself in the foot. Always give yourself the best the best options available or the best mathematical, benefits available so that you're not, basically hurting yourself in the process. So that's where, I talk about leftover money whenever the income goal is met. Income, emergency, and growth/inflation can be customized for more efficient uses, as opposed to just saying, hey, I'm receiving an income stream. But I came to my oh my gosh moment. I need more income. Well, if you chose that pension option, it was a single life or a joint life option. They're just paying you an income stream. You can't just call up the pension company and say, "Hey, I need more money out of this." They're just paying you that lifetime income. So really, your duty is to try to live as long as possible, so that every year you're living, you're able to take those monies and really benefit it to you in your pocket. So those are obviously some different things. If you want to leverage an income stream through your pension, leverage an annuity stream through your pension, or leveraging the lump sum option with your pension, those are kind of the pros and cons. What are some solutions, and really how should you dissect this from a larger picture, and then try to make it more specific to really help out your situation. So now you kind of understand what some of the pension options are, the lump sum, and you're getting this different paperwork as you start nearing your ideal retirement date. What are some solutions, or really how to figure it out? And it all goes by a case-by-case basis. And it's saying, what is your dream retirement? What is the retirement that you envision to say, okay, I could wake up and do whatever the hell I want, at that time? Is that something that you want to retire when you're in your 50s? You want to retire in your 60s? You want to retire in your 70s because you love your job? What exactly is that, ideal retirement scenario? Do you always want to work? Do you always want to do something? Do you want to do more of a hobby than actually, staying with that employer? So get very detailed on what that vision is, really what that dream is. And then also, put pen to paper and say, every morning I want to wake up. I want to, go for a walk, go for a run. I want to do book clubs. I want to, once a month, I want to visit my grandkids or take a vacation, or I want to, first couple of years, visit Europe, or whatever that situation is. But as long as you're writing it down, you're marking it down, it's putting into some sort of reality. Then take a step back and say, okay, well, what's the math involved with that? If this is ideally what I want, what are some of the expenses that are going to come along, with this situation? So maybe right now you're paying for a mortgage, but when you start nearing your ideal retirement date, or in your ideal retirement date, maybe the mortgage is going to be completely paid off. So now that large expense is going to be taken care of, every single year, where you could have less expenses at that point than maybe what your expenses are right now when you're living. So really, figure out what your budgeting analysis is and saying, okay, what are these typical expenses going to be? And then realize, okay, how much income do I actually need? My employer is going to be giving me a pension income stream. Is that pension income stream necessary, or should I take the lump sum and then customize that better so I have more money in my pocket, I can make sure my beneficiaries are covered, and I still have the income, my emergency, and my growth related needs? All three of those aspects are still being, figured out correctly. So leverage the correct solutions so that when you start nearing that retirement date, or in that retirement date, there's no financial stress. So if there's no financial stress and you're able to live the retirement you envision, you have no deathbed regrets. Let's say you fast forward and hopefully you live to your late 90s, age 100, whatever that is, and you're looking up at your family members, you're in your deathbed, you're saying, wow, I was able to accomplish every freaking thing that I wanted to up until this point because I made the correct mathematical move of my income was greater than or equal to my expenses. I never had to go back to work. From my pension, or from that portion of lump sum that you were able to leverage, the income stream from Social Security income, and then obviously any sort of remaining assets that you were able to leave some sort of legacy if that was important to you at that point. So you're going to have a smile on your face, and it's going to give you that further peace of mind. So obtain confidence to stop working and start living as quickly as possible, and it's very attainable by just looking underneath the hood and realizing it's not magic, it's just math. Backing up into the math and making sure that you're avoiding the most common mistakes and not just getting caught up in the shiny object, but actually taking a calculated move, it's going to pay dividends, in the future. So, that's some of the different things that, and the reason why I feel called to really create these videos for individuals is because I've seen the scenarios. I've seen the situations where individuals were freaking terrified, and where they were overconfident, thinking that they would just trust the system, and it either blew up in their face, or we were able to help them avoid a large mistake and put them on the correct path so they were able to live. Now, whether that individual passed away prematurely or they're constantly living, it's an amazing feeling as an advisor to really kind of give that individual life and giving them that peace of mind and that confidence throughout retirement. So that's why I'm constantly creating these videos for you guys. If you did find value in this and you want to speak with one of our advisors, simply call our 1-800 number up on the screen. It's 1-800-566 or 566-1002, or click on the calendar link embedded in the description of this video. What we're offering for anybody watching this video and referencing this video is a free 20-minute connection call where we just want to get really deep on what's most important to you. Inch wide, mile deep. Figure out whether the path that you're on right now is going to, create that successful retirement, or if there's little tweaks that you should be making, or just kind of getting a secondary opinion to say, hey, this is what I'm feeling. I think that this is, essentially the right move, but, what are kind of your thoughts on everything? So, that's what we're here for, to try to provide some value, regardless if we ever work together or not. And, feel free to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos and get some of the most updated content. Thank you so much, guys. Hope you enjoyed, and we'll talk to you soon.